Well, that US yield curve just keeps getting flatter. We're now at levels not seen in about a decade. What does this say about investors' economic outlook? Well, it depends on who you are. So let's get over to bond market guru Dan Fuss, who's a vice chairman of Loomis Sayles, who joins us now from Tokyo. Dan, let me throw up this chart that we're talking about. This is a yield spread between the 5 and 30-year Treasury. You can find it at hashtag BTB5080. We've seen that this is the flattest curve since November 2007, which happens to be right before we plunged into that 18-month recession. BlackRock saying that this is because we're seeing crazy wrong pricing when it comes to long duration treasuries. Bill Gross is gloomy. He says we could be getting to the point where this is going to portend some sort of major negative economic event, aka, I guess, a recession. Where do you sit on this argument?
Well, first place, I do agree that there's a tremendous demand for long call protected, high quality in the dollar space. And that's going on, and that's been present for quite some time, and it's more intense now. It's principally from the liability matching of long-dated duration, most of which is corporate pension. Now, Bill has a point in that, and he tends to have good points. This is reminiscent of past times prior to the storm. Having said that, it's been off and on reminiscent for the last, 5, 6 years. So you're looking at a period of time where any measure of volatility or any measure of spread is at all-time lows and showing stability, except spreads are slightly narrowing even more. So those of us who have lived through history are reminded that this is a tricky time because you want to push for yield, and you're being paid less and less and less for it. So that's where the caution comes from. And it makes it more than somewhat difficult to run money in this time. You can do it, and it's a lot of little stuff.
The consensus seems to be you buy duration. Do you see any duration risk in this sort of environment when you do have the Fed? It looks like even under Governor Powell, Chair Powell, I should say, we will be continuing to tighten and there will be continued low inflation.
Well, the continued low inflation part of it, I think, is subject to some question. Now, I don't know the detail on this new thing that the Fed of New York has on the inflation measurements. I see the output of it, which indicates that maybe inflation is going to be a little bit higher, and in fact, for a longer period of time than we might think. In other words, the inflation trend might be trending more up and be a bit stronger. That's not the general consensus at the Fed, but that's what the model shows. Now, it's quiet, it's peaceful. The only central bank that's of the majors that's showing, of the three majors, that's showing upward pressure in their thinking, upward rate pressure, is the U.S. Here in Japan, that's not the case, and also in Europe, that's not the case. And so the U.S. Fed is somewhat ahead of the pack, or you might say isolated in that regard. And that presents a problem on raising rates, because we already have a currency that, not this past year, but prior to that, was reasonably strong. It's showing some signs of strengthening again. And if we raise rates in this context, and we ought to for domestic reasons, then it attracts money from overseas. So that's the bind that the Fed is in. I think they're going to do it. I think next month we'll see a quarter up. I think they will do their best to make sure of their fundamentals before they raise rates next year, which I do expect they will. The U.S. economy is strong. There's no two ways about that, measured however you want to measure it. We have some social problems that play out in the labor force as to availability of labor. But there's no shortage of jobs by and large, and the economy is strong. So I can go into more detail if you'd like, but just look at the numbers. It's strong.
Dan, you got 3 conviction trades. Tell us about them and give us your rationale.
Well, Rashad, my major conviction is there isn't much on offer. And so you have to go out. The major thing that we're doing is not extending. As a matter of fact, we've cut substantially. Several years ago when we talked, the average maturity in the bond fund was about 13 years. Now note I'm using maturity, not duration, because when rates change, duration can mislead you. Our average maturity now in the bond fund is about 6.4 years. We've cut it in half. The average quality's gone from Baa3 to single A3, just about into single A2 territory. So we've brought up credit. Now you say, okay, that's well and good. How are you going to make money? Well, it's a lot of smaller things, some on the credit side, but credit spreads are very narrow. Not always, though. There will be sectors on the credit side where the spreads will narrow and widen. Best example of that is in the energy area. There are a few others. I don't like to get too specific and spread the word on it. And you can add a surprising amount of value that way. It's not a great long-term strategy, but it's a way to deal with this. So the temporary dislocation on the credit side, the rare anomaly on the yield curve, which doesn't really happen in treasuries, but does in corporates, normally with the overpricing of the 5-year area. And then just the one by one things, which bonds are going to be tendered for or called, a lot of guesswork on that. But surprisingly, if you do your homework, you can pick a lot of these up. I'd like to focus for a second, Rashad, on the one thing that's happening here is a lot of U.S. corporations are looking at the current array of things and saying, gee, it's a good time to pay down our debt and reissue. And so they'll tender, and then they'll come out with another public offering. And if you're paying attention, you can add a lot of value there. So they're not long-term conviction things. They're short-term tactical.